Welcome to The Honest Trader. This video is going to be an attempt to condense everything you need to know to be a Forex or binary scalper. So we'll first get started with the three motions of price action. Price action is going to be a very important understanding for the market, and so that you can find an opportunity to scalp within the market. So obviously the first trend we'll talk about is the uptrend. This is essentially when the underlying stock, commodity, or whatever you're looking at is just trending up. And you can see this trend on the 1 hour chart, like this example. So this is the euro dollar pair, and you can see the 1 hour chart. And if you were to look from left to right, it's an uptrend, right? We'll talk more in depth about how this is actually trending up in the later portion of this video, but this is a general uptrend that you can see on the 1 hour chart. The next trend is the downtrend. Everything goes up, must come down, right? So same euro dollar chart, 1 hour candles, and you can see from left to right it's on a downward trend. And the next trend or motion within price action is the consolidation. So when I first got started trading years ago, I didn't understand what consolidation was. I wasn't even aware that the market could move quote unquote sideways. But when the market moves sideways is essentially when it's pretty much flat, right? If you were to look left to right, it's pretty much flat. It's not moving in any directional trend, any major trend at least. And you can primarily see it's just flat, right? So this is actually called consolidation. And again, this is the euro dollar chart, 1 hour candles. So let's talk about how to use consolidation boxes. Consolidation is essentially when the price, you could think of it as when the price is trying to figure out where it's trying to be, right? The market is trying to decide, should I go up or should I go down? And as it's doing this over and over, it's essentially creating a pattern where it's just moving sideways. And so let's talk about that. So, in the euro dollar chart, 1 hour candles, we could see we had a huge price going down, right? Price movement going down. And then we consolidated. And then we moved down again. And then we slowly started to trend back up. So this consolidation, I drew this box in here on the chart. But this consolidation box is very important, right? Because if you did not understand that the price is consolidating in this period, you may have saw this first candle and say, okay, well, we may move back up. And then you may also believe that this is a correction or confirmation candle, and then hedge your bets to move up, right? But as you could see, the price was just trying to figure out, do I really want to be this low or should I go higher, right? And based on this candle, you could see that it, especially the wicks on the candle, right? You could see it tried to go up, but then it came back down. And then the next candle showed that it just didn't like that price either. So as a scalper, what you want to see and recognize is, all right, where are these consolidation boxes? Because you don't necessarily want to be trading when the price is trying to figure out where it wants to be. That's where you lose your money, especially if you're trying to hedge a bet in a directional movement, right? You don't want to be in where the price is figuring itself out. What you want to do is you want to look for confirmation inside or outside of the consolidation boxes. And we'll talk about that in the next one. So this is actually a euro dollar on a 5-minute chart. And you could see I had some consolidation boxes here, 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 and here. But if we zoom in on it, the consolidation box I was using to see if the price is going to move outside of the box. So once you see that the price has been consolidating for a period of time, what you can do is you can draw the box, right? You can draw the box over it, and then you can even set an alarm to say, if the price moves here or if the price moves here, alert me, right? Because what that means is if the price moves outside my consolidation box, it's probably going to continue in that trend, right? And we're going to see a few examples of that. So in this scenario, the price moved outside the consolidation box and it moved down. So what you could have done is you could have purchased a bet on this candle or this one, but you essentially it's a scalping move, so you have to get in and out quick. So then we'll look at the next one here as well. You can see I set up the consolidation box saying that in this period, and if you drew your, or if you put alerts in, you could have said, okay, if the price moves outside of this box, alert me. Now, in this one scenario, you could see that it did move out, but the wick came right back in, right? So did it stop consolidating? I don't think so. You could even have drew this box more to say this was the entire consolidation period, right? And then continue your alert system to say that now that it actually moved outside of this consolidation box, I'm gonna make a bet on this candle here. So that's two examples of how you could use the consolidation box. So this is actually on the 1 minute chart now. Euro dollar 1 minute candles, same thing. And this is a result of me actually using the consolidation box. And I just took some screenshots for this video. So I'll talk more about what consolidation is, but you can see here we had a rally, we moved up, right? The price moved up, and then the price decided, okay, do I really want to be this high? And it took 1, 2, 3, 4, 5, 6, 7, 8 minutes to determine, do I like this price and do I want to stay at this price? So this essentially consolidated for this entire time. So I was just watching this during this time. I didn't make a trade. I just continued to watch it. I continued to watch it, set my alerts, a little bit outside of the consolidation box, and then it actually, hit the alert, and then I could make a bet that it's going to continue down. Get in, get out, scalp your move, and keep it going. And let's look at the next one, right? So here you can see that I drew this small consolidation box for this, I would say 3 minute period where it was consolidating. I set my alerts, and then it hit. But then I don't believe I got in, but I could check my trading history. But you could see it consolidates, makes a move, and we could even review this and say that it consolidated, made a move, and then continued to consolidate. Then it made a move again. And now, guess what? It's consolidating again, right? So you're going to ask yourself, why is this consolidating so many times? But that's just the normal motion of price action in the market. Because with every movement, you have to remember that the market is trying to understand, do I want to be at this price? Do I want to stay at this price? And if not, do I rally up or rally down? So let's talk about the tide theory. I started to, make up this own theory of mine, and I was going with the name tide theory. Then I did a little research and realized that this guy named Elliot did this theory long before me. So kudos to Elliot. He called it the wave theory. And the wave principle posits that collective investor psychology or crowd psychology moves between optimism and pessimism in natural sequences. So I was right saying that it was a tide. He said it's a wave, fine. These mood swings create patterns evidenced in the price movements of markets at every degree of trend or time scale, which is true. I agree with him. But here's the thing with normal traders, right? Or fundamentalist traders, or even technical traders. They make things very complicated very quickly. So look at this. These are the rest of his definitions and rules and wave 1, wave 2, all these things, right? And then look at the chart. It's pretty complicated. And if you're doing like 5-minute scalps and things like that, it's going to be very difficult to catch these things. So I thought of it as a tide. And if you looked at a tide on the shoreline from an aerial view, right? If you could just zoom in here and think about this, what happens with the tide, right? The tide moves in and it moves out, it moves in and it moves out. And we know that it keeps doing that, right? The tide always moves in and it always moves out. But if you looked at the tide from the morning to the night, what's going to happen? The tide is going to come in to the shore, right? So you're going to have high tide. So you could say that from, let's say from 6 a.m. to 6 p.m., the tide's going to come in. From 6 a.m. to 6 p.m., tide is going to move in, right? That's the general trend. However, if you said from 6:10 to 6:12, what's happening to the tide? It's just moving in and out normally, right? In and out, no general trend, just in and out. Now, let's say if we looked from 6 a.m. to 9 a.m., what's going to happen? You're going to see a noticeable change that the tide actually moved in. So depending on the time scale you're looking at, right, you could say the tide is moving in, it's no real change, or the tide is moving in, right? So what we'll do is we'll use that to make up some trend levels. So the trend levels that I recognize from my trading is I would call a level 1 trend, level 2 trend, and a level 3 trend. So level 1 trend is kind of like looking at the tide in a very short period of time, right? And you're looking at the 1 minute chart, 1 minute candles, and you'll see the normal motion of the tide. It's going to be moving in and out, right, normally. But if you look at the 15-minute candle, you'll be able to see, all right, is the tide moving in overall or is it moving out overall, right? Because you could, if you were looking from 9 p.m. to 9 a.m., what's going to happen? The tide's going to be moving out. So if you looked at the level 2 trends, seen using the 15-minute candle, it shows the corrections or confirmations in the market, right? So if the overall trend is showing that the market is moving up, the 15-minute candles may confirm that, or it may even signal that this is going to correct and going to change. And then the level 3, you could see using the 1-hour charts, right? And so you could see the overall trend of the market. So that's the basic introduction to the tide theory. I hope that makes sense to you. But essentially, you look at different time scales within the market to see how the market is moving. But the closer you look, the more it looks like a tide. The more it looks like normal, natural patterns within the tide. But you don't want to continue looking at the 1 minute chart all day, every day, because you won't realize that the overall tide is moving out or the overall tide is moving in. So you want to be cognizant of all 3 levels when you're trading. But obviously, when you're scalping, you just look at you look at the level 3 trend, make your adjustments, look at your level 2, just to confirm if things are moving in the right direction, in confirmation with the level 3, and then you just scalp off the level 1 charts. So that's the introduction to the tide theory, and that should explain price action in the market to you a little bit better. So let's talk about the runner's theory. So this is a second theory I'm going to use to try to explain the price action movement in the market to you. So if you're going to run up a hill, right, for those who actually like running, you're going to use a lot of your energy, and you're going to be running up this hill, and you're going to use a lot of your energy doing it, right? Now, once you're running up the hill, you may even get to a point where you get tired and you get a little fatigued. And so you slow down, right? You may catch your breath, and then you may continue running up the hill. So if you think about it, if you're running up the hill in the market, you're moving in an upward trend, right? And then you get a little tired, so you consolidate. So you just rest for a while, and then you may run up again. So that is how most uptrends are depicted in the market. And to confirm that, let's go back to the original chart I showed you with the uptrend. So if we started from here, let's just say we started from here to be generous. We start on an uptrend, right? We are running up this hill. Then we get tired. So then what happens? We consolidate. But with the market could decide, do I want to still run up this hill or do I want to turn around? So for a brief period in time, the market turned around. For 1 hour, the market turned around. And then the market decided, okay, I'm going to continue running up this hill. This was actually a hill I wanted to be up. Then it got tired again, right? Got tired again, but then it continued running up the hill. So this is a very simple introduction to it. But as you could see, if we started from here again, running up this hill, We used our energy, we got tired, we consolidated, turned around, then continued running up the hill, got tired because we, ran so much or so quickly, got tired, rested for a while, continued running, and then turned around again. Okay, so you could think about it that way, and that could help you understand the price action in the market. Now, if we talk about this as it pertains to, supply and demand, economic analysis, and all those things, you could say that as the price continued to move up, and this is the more correct definition of all of this, as the price begins to move up, those that were betting against the price, they start to sell, right? So they sell, and then people who are speculating want to decide, should I get in or should I get out? And then this indecision creates this consolidation period. Another thing on breakouts after the consolidation is you want to look for volume. So maybe in the next video I'll talk more in depth about volume, but you want to make sure that when you're breaking out of your consolidation box, you're breaking out on a lot of volume. And so if we're thinking about it with the runner's theory, you could think that the runner who got tired running up the hill needs a lot of energy to continue running up the hill, right? So if I'm catching my breath in this period here, I hope that when I continue my direction, I have enough energy to continue in that direction, continue running up the hill. So that energy could be looked at in the form of volume. And so at the bottom of this chart here, I have the volume underlying. And so you can see how much volume is actually coming in or coming out to move the price. So after your consolidation, once you break out of the consolidation, you want to be breaking out on a lot of volume. And so if I was in the market at this time, I would have definitely got in, but I wasn't. I wasn't. I'm probably sleeping. But the fact is that you're breaking out of this consolidation period on a lot of volume. You have a lot of energy after you took your break and you still decided this was the right decision. You can also see here, over here, that we came down on a high volume. So this is also indicative of maybe a consolidation box here. And you can definitely see that this is a consolidation box. And afterwards, we're breaking out on a lot of volume. So that's another thing you want to be looking out for. So let's look at the downward trends also. So when the trends are going down, the trends also go down with consolidation. So if we start here, we can see that this is just a consolidation box. We broke out of this consolidation box with high volume, right? Then you also had higher volume to come down. But then what happens, right? We came down. This is the downward trend now. We came down, and guess what happens? We consolidate again because we get tired. So all the volume comes out. As you can see, the volume goes low. We get tired from running down the hill. Excuse me. So we get tired from running down the hill, and then we continue running down the hill on high volume, right? Then what happens again? We consolidate, or you can even see that this is a longer consolidation period. From running down this hill for so long, we got tired, we catching our breath, and then we continue to run down this hill on high volume. So if you're looking at it from the runner's perspective, you could definitely see that the energy of the runner is equivalent to the volume within the stock or within the underlying price. And then you can see the direction is just equivalent to the direction the price is going in, right? If you're going up or down the hill. So in the downtrend, let's just recap this. We consolidate, we go up, and then we go down on high volume. I guess this is the key here, going down on high volume. We kind of consolidate again, then we go down again. Then you could also say that you consolidated here for this entire period of time. Then we continued down, right? So when you're talking about downtrends now, you understand that it's not just a straight line down, right? Because you're going to consolidate in periods of time. And as a scalper, you really want to look for these consolidation points to say, all right, you're consolidating here. I'm going to set my alerts here. And if the alerts hit it, I know which direction to go in, right? So it's that simple when you understand how to use the consolidation box and when you understand how to gauge price action in the market. So hopefully I could do a second video to determine, to talk in depth about more of these terms, and then we'll review some of the trends that you should be looking out for, and support and resistance. And after that, I believe you should be ready to go in scalping.